Let me share with you some key reminders in case you feel stuck, you feel lost with your stock portfolio. And the first reminder is to remember the power of compounding. This is the wealth accumulation system. This is the snowball effect. Money makes more money. So I'm sure you are aware of what compounding is, but sometimes we lose track of what is really important. We don't want to trade stocks. We want to invest for 5 years, 10 years, 20 years, 30 years or more. So if you are making a reasonable percentage of annual gains every year, like, I don't know, 5%, maybe you feel bad winning like 5% every year, 6%, 7%. That's no big deal, because in 20 years, 30 years, it will make wonders. It will create an enormous amount of wealth, because if you keep delivering these results year after year, in the long term, you will have a lot more money. Compounding works, and if you think compounding is strong, you still underestimate what compounding can do with your wealth. This is so strong that, mathematically speaking, our brains are not used to dealing with compounding. We are used to doing the multiplications, additions, but for compounded wealth, compounded numbers, that's very hard. So there is a rule of 72 to explain how long it takes to double your money. And it's just a simple formula. For example, if you have a 7% yield every year, you will double in 10 years. And if you have a 14% annual return, you will double in 5 years. And if you have a 26% annual returns, you will double in 3 years. If you think in terms of doubles, life will get much easier. So don't worry about your short-term performance. Maybe you are underperforming. That's totally okay. If you keep track of what really matters and you think in terms of doubles and you have a clear focus of what your objective is, you are in line with your vision. This is exactly what you want, but you have to track these things. Track your performance, track if this is aligned with your goals. And I put here, start investing as early as possible. I'm sure you have a job. You can put more money to work every month, every year. The more money you start with for the compounding, the more money you will have at the end of the journey. So maybe you are hesitating, maybe you are stuck. I would advise to keep investing as much money as possible day 1, day 2, like in the first days of your investing journey. And every time you have your salary, your paycheck, some gifts, just allocate more money to investing, because if you think in terms of 10 years, 20 years, 30 years, it will have a huge impact on your net worth. And this is exactly the reason why you're investing. So your goal is aligned with you if you follow the rule of compounding, if you really remember the power of compounding effect. Okay, my second reminder for you is to keep investing is what you understand. Maybe we hear a lot of things in the news, a lot of IPO, sexy stocks, sexy businesses, and trendy environment. The goal to not do mistakes is to keep investing in what you really understand. If you can't explain how a company makes money in simple terms, like explain it to a child, it's probably not a wise investment. These principles helps you steer clear of risky or overly complex investments. Yeah, sometimes you want to ride the wave, the next wave, AI, robotics, I don't know. And you make a bet, you make an investment, but you've not really done the due diligence. You don't really know how the AI chip makes money. You don't know the relationship with the customers. You don't know who the customers are. So the simple rule is you have to pitch your investment to a child under 2 minutes. If you can't explain with simple words, it's probably too complex. So you have to boil things down to what a child can understand. This is my advice here. And sometimes you want to get smart, you want to feel smart, so you invest in very complex investments like derivative, alternative investments, instruments, because that's good. You feel very intelligent when you invest like this. you talk in terms of EBITDA, adjusted EBITDA, and you lose track of what really matters is to invest in simple businesses that you are dead sure they will be better in 10 years. You are 99% sure that the business we invest right now will be better in 5 years, 10 years, generate more revenue, more earnings, more cash flow, more returns for shareholders. This is your goal as a long-term shareholder. So I would say invest in what you really understand. Like it could be very, very simple investments, like paint, like swimming pools, like the Monster energy drink. I mean, they sell very simple products, but they generate a lot of money. And in 10 years, these simple businesses will generate a lot of cash, a lot of revenue, earnings, will do buybacks, will give dividends, and that works. That's a perfectly fine reason to make money. Okay, next point. Only invest in profitable companies. Yeah, same vibe from the second point. Maybe you want to find complex investments. Maybe you want to invest in the next big thing. You think it is the next Amazon, so it doesn't make money, but maybe it will turn profitable in 2 years, so it will be fine. Most of the time, turnaround plays don't turn around. Most of the time, unprofitable companies stay unprofitable and are fueled by debt. So only invest in profitable companies is a great advice that I wish I knew sooner. Stick with companies that are already generating profits and have been generating profits for years and years and years, not recent profit. Avoid speculative bets on unproven businesses. That could be electric vehicles, that could be the AI boom. Sometimes you want to feel smart and invest in the next big thing that will grow. You see the investor presentation of a company that expects a lot of, like the guidance for next year is amazing, a lot of growth. Most of the time, these sexy businesses don't turn around and they don't go bankrupt, but they stabilize or the earnings decrease over time. That could be a mess. And that's how you do mistakes. And let me tell you, your goal is to avoid as many mistakes as possible. The goal is not to make as much money as possible. The goal is to survive in the long term and avoid all the mistakes. Because if you do a mistake and you lose 50% of your investment in one day, you are out of the game. You have to wait a couple of months so that it rebounds. In case it rebounds, that could be a mess. The goal is to avoid making mistakes. And if you stay clear of on unprofitable companies, you will be safer. Okay, focus on the long term. Yeah. In this YouTube channel, we are long-term stock pickers, long-term stock investors. And I would say, don't panic about the noise in the short term. Don't panic over short-term market movement. Stay focused on the fundamentals of the companies you're investing in. Invest in businesses with a proven track record. Avoid IPOs and companies with no long-term performance history. So yeah, there are 2 points here. First, avoid the noise. Don't stress. Don't let your emotions leave you to doing the wrong decision. There will be messy situations, some crazy macro situations, inflation, interest rates, government deficit. This is not what matters in the long term. What matters in the long term is if you pick a business, you want it to be better, more revenue, more earnings, more cash flow in 10 years, 15 years, 20 years. Macro doesn't matter. And there is a quote from Peter Lynch in the area of, if at the end of the year you have spent 14 minutes thinking about macro, you have lost 13 minutes. So yeah, don't waste a lot of time thinking about macro. There are a lot of big investors like Warren Buffett, Charlie Munger. They all say the same. Don't focus on the short-term events, macro, job reports, inflation data, interest rates. This is not what matters. This is what matters for short-term traders, which you are not. So don't focus on this. Don't let your emotions do you the wrong decision. Just focus on what really matters and focus on the long term. Okay. And yeah, you want to really do your analysis for businesses with a proven track record. You want profitability over a decade, 2 decades. Don't rush into investing in IPOs. These are most of the time unproven business models. You have a lack of track record. You don't know if management is honest or not. You have only 2 years or 3 years of analysis for your data. So maybe they have twisted, they have cooked the number so that they look good. You don't know what can happen, and I would stay clear of IPOs. That's exactly the same advice that Warren Buffett would give you. Don't invest in IPOs. The next one is be patient and disciplined. Volatility is part of investing. Wait for the right opportunities and stay true to your principles, even when the market tempts you to act otherwise. Build your watch list and wait and wait. Your goal is not to do an investment every 2 weeks, every month. Your goal is to be right. So you can make 2 decisions per year, 2 buys, and that's perfectly fine. If you are correct, if you are right on these 2 investments, you are a great investor. You will generate great returns. You can make a lot of money out of these 2 investments. Be selective and don't have FOMO, fear of missing out. There will be volatility. There will be some tweets, some event in Japan, in the US, in Canada, in Europe, some bankruptcy. There will be volatility, and the prices of your stock on your watch list will drop for some reason. It will happen. Just wait. Just wait, and just wait patiently. The goal is to prepare. Build your watch list. And in case we have a crash, like minus 20%, minus 30%, you are ready. You have done the work before. You have built the watch list. Our goal is to be a detective and analyze stocks and stocks and stocks. And in our bag of stocks, we have many investments, potential ideas. So when they drop in value, when stock price drop, you buy at a cheap price. But you have to be patient and disciplined. Okay, next point. Never overpay. Yeah, this is linked to being patient and disciplined. You don't want to pay when stocks are expensive and sexy and trendy. This is the hot stock pick of the time. Avoid paying too much for a stock. And I would advise to stick to companies with a PE ratio under 30 to make sure you are not overpaying. Yeah, there are a lot of big investors. I'm thinking of Terry Smith right now that has never paid a PE ratio above 20. Like above 16. So you have a benchmark of, okay, I will never pay a stock at a PE ratio above 20. So the threshold is between 0 and 20. 0 because you want your business to be profitable. So between 0 and 20. And you play with these numbers. If you like a stock, if you like a company with a PE ratio at 38, you just analyze it, put it on your watch list, and you wait. And you wait. This is exactly how you can do stupid mistakes. To think, this business is so good, it deserves a PE ratio of 35, it is the next Costco, the next Amazon, and you buy, and then it drops 50%. So you went from a PE ratio of 38 to 19. 19, this is not cheap. This is fairly valued. So the stock has dropped 50%, but the investment case is the same. So yeah, to avoid this situation of re-rating, so a devaluation in multiples, just stick with low valuation. And I would say PE ratio under 30 is a good threshold. Don't go above this one. And yeah, the last reminder for today is learn from the best. Maybe you are feeling stuck. Maybe you are lost. So maybe now you have some key elements. Let's say profitable companies, proven track record. And if you want some direction, some inspiration from the best investors in the world, you can learn from the best investors in the world. There are public letters. You can spend hours reading what Warren Buffett has said about this business or this business. You have François Ronchon. You have other key investors that have outperformed the market for decades. And they will tell you exactly how to do this. And you have letters from Seth Klarman, you have Nick Sleep, you have many investors. Make it a habit to read letters and insights from the world's top investors. Their experience and wisdom can provide valuable lessons for your own strategy. Yeah, exactly. If you lack some directions, take advantage of living in the digital world. You can read the mind of Warren Buffett, Charlie Munger, or other investors, like big investors, successful investors, for completely free. Take advantage of this opportunity, and in case you want to take inspiration, have a clear framework, you can read and learn from the best. That's it. And in case you want to learn from the best and have personal guidance, I have a coaching program where we do exactly this. We take what works, we take what the best investors do, and we apply it exactly. So we have a clear framework. We know how to analyze stock from A to Z, and that works fine. And I've been doing this for years now, for 7 years, and I have a performance of 24% per year annually. So you just clone what works and apply it to yourself, to your circle of competence, and you will be fine. So that's it for today. You have some key reminders in case you're feeling stuck with your portfolio, you lack some guidance, you lack motivation, you are underperforming. Understand the power of compounding. Trust time. Invest in what you understand, so avoid complex situations. Only invest in profitable companies. That's a safer way to make money. Focus on the long term and don't panic over short-term noise. Be patient and disciplined. You build your watch list and you wait for stock prices to drop. Never overpay. That's how you make stupid mistakes. And you learn from the best. You take what works and apply it for yourself. That's not really difficult. That's quite simple. You have key principles from Warren Buffett, from Charlie Munger, Monish Pabrai, Guy Spear, all these successful investors, and you just do it, and it works. And I'm not the only one in this situation. There are many individual investors that applied the same formula, and it worked. So that's it. In case you want to join the coaching program, you have the first link in the description to book a call with me and see if you qualify and see if we can work together. And that's it. I wish you a good day. Bye bye.